welcome to the Mortgage Rate Weekly Market Update for the week of May 7th, 2018. Hello, I'm John Thomas with Prime Residential Mortgage to give you your update. Well, last week, mortgage rates were able to end the week slightly lower than where they started. Take a look at the bond chart on the screen. Mortgage rates have been moving higher since the beginning of the year, and 2 weeks ago, they hit the 5-year high for mortgage rates, as you can see right there. That's the 5-year low for the mortgage bond, which is opposite of rates, so it was 5-year high for the rates. And then you can see the short-term trend has been for the bond to rally off of that 5-year low, moving the bond higher, which moves interest rates lower. Now, on Friday, the bond hit the 25-day moving average right there and was turned lower. What we're hoping is it can break through that 25-day moving average. If it can, we can see mortgage rates move even lower. But if it gets turned lower again this week and falls below, we could see mortgage rates continue their trek higher. So we're going to recommend carefully floating your mortgage rate to start the week to see if mortgage bonds can rally above the 25-day moving average, move mortgage interest rates lower. But be careful. If mortgage bonds shift and start selling off again and resume that long-term trend, and they break below a floor of support, we could see mortgage interest rates move back to the 5-year high that we saw 2 weeks ago. Now, if we dig into the economic news, big report last week was the jobs report for April 2018. It was a disappointment. We only created 164,000 jobs. That was lower than expectations, 190,000 jobs. In that report, the unemployment rate did drop from 4.1 to 3.9%. But it dropped not because of people going back to work, but because 236,000 people dropped out of the labor force, no longer counted in the number. So that's not a good reason for the unemployment rate to drop. But this is the lowest rate, 3.9% is the lowest rate for unemployment in almost 17 and a half years. Now, the all-in U6 unemployment rate, which includes total unemployed plus all persons marginally attached to the labor force plus employment part-time for economic reasons, it dropped from 8% to 7.8%, the lowest has been in 16 and a half years. Some people feel that the U6 is a better measure of the unemployment. Now, wage growth fell to 2.6% on an annual basis, down from the high of this year for 2018 of 2.9%, which was recorded in January. Now, wage growth is important for the steam of the economy moving forward. Without wage growth, consumers don't have extra money to spend on things. So that was not good news in the report. The month-over-month hourly earnings did rise 0.1%, but that was versus 0.2% expected, so that was not good either. So for the economy, not great news, but for mortgage bonds, that is very bond-friendly news because there's no wage inflation. Then inflation is the enemy of bonds. No wage inflation, bonds can rally off of that, as we did see on Friday. So if that continues, that would be good news for bonds. Now, in other economic news, one of the questions I get a lot is, when will the next recession be in the United States? Because we're past due for one. Well, there's a good correlation between unemployment rate and recession, and it's opposite what you think. Take a look at the graph on the screen. When we look at chart unemployment versus timeline of when recessions hit, the recessions don't hit at the highest unemployment rate. They actually hit at the lowest. So on the graph, those highlighted bars are when we hit a recession, and they're always on the dip at the lowest point of the unemployment rate before it switches higher. So based on that, you can see where we are right now. We're right somewhere near the dip. So we're looking for the unemployment rate to rise, which could trigger the next recession. So experts are warning that could be in the next 2 years. So 2019, 2020, we could see a recession in the United States. Now, that's bad news economically, but typically mortgage rates do fall during a recession. All right. Then we saw weekly initial jobless claims come out on Thursday. They showed 211,000 claims filed for the week, which was up slightly by 2,000 claims from the 69-year low recorded the previous week. This was also 13,000 claims lower than was expected. Remember, initial jobless claims measure the number of individuals filing for the first time for unemployment benefits. So this shows the labor market's doing well. It contrasts to the jobs market report, which wasn't as good, but the weekly initial jobless claims still showing good. So not quite correlating there. Now, in the housing news, we saw CoreLogic release their home price index for March 2018, and it rose 7% year over year from March 2017. It was up 1.4% from February. The cause of this is the high demand for homes and the limited supply of homes for sale. And also, new home construction is running below historical levels. So all that together is like a perfect storm to drive home prices up. And we don't see an end in sight of the shortage of inventory, which means we're expecting home prices to rise. Now, CoreLogic's forecasting a rise of 5.2% from March of this year to March of 2019. So it's still a great time to buy to take advantage of this price appreciation. Then we saw pending home sales for March 2018 were up 0.4% from February of 2018, but they were down 3% year over year from March of last year. Now, why were they down? Again, it's tight inventory. There's buyers out there that want to buy. They just can't get contracts because the choices of homes available just aren't there. Now, chief economist for the National Association of Realtors said that healthy economic conditions are creating considerable demand for purchasing a home, but not all buyers are able to sign contracts because of the lack of choices in inventory. He also went on to say that steady price growth and the swift-paced listings are coming off the market are proof that more supply is needed to fully satisfy demand. So again, more proof that home prices will continue to go up as this demand for housing is not going to be met anytime soon. Now, in the local news, we got the next first-time homebuyer seminar on Saturday, May 19th in Newark, Delaware at the Christiana Hilton Hotel from 10 a.m. to noon. And then we also have one that day in Timonium, Maryland from 10 a.m. to noon at the Red Lion Baltimore Hotel off of 83. And then we've got one in Wilmington, Delaware on Wednesday, May 23rd from 6 p.m. to 8 p.m. At Independence Mall off Route 202 at the eXp Realty Office, Suite 88. Now, you can register either one of those events, but give us a call at 302-703-0727 or online for the Delaware events at www.delawarehomebuyerSeminar.com or for the Maryland events, www.marylandhomebuyersseminars.com. Look forward to seeing you guys next week.